I want to turn to the markets here, though, as we are seeing an overall surge. When you look at all 11 sectors right now in the S&P 500 in the green, perhaps a record end to the year on the horizon. Of course, just a few trading days left in 2021. But where do we go from here? For more on that, I want to bring on John Mowrey, NFJ Investment Group CIO, joins us here. And John, appreciate you taking the time to chat with us. I mean, when you're looking out into next year, I assume, some of those themes are going to be carryovers from 2021, but what do you like and what should investors be watching?
Zack, great to see you. And, as we finish out the year, as you stated, it's been a spectacular year for equities. We very much believe that valuation should shape investor expectations as we look into the new year. One of the things that is on our mind is the rate of inflation. It has been elevated. It's the highest that we've seen since the 70s. And one interesting statistic I'll share, from 1970 to 1989, the annualized inflation rate was around 6.2% over that time period. So pretty meaningful inflation. But the dividend growth rate of the S&P 500 exceeded that at 6.5% annualized over that same time period. So I think dividends, and particularly dividend growth rates, are something interesting that investors should be paying attention to. And there's a lot of dividend growth rates that are favorable as you look across industries and sectors. And particularly with profit margins where they are, I think that provides an interesting way for investors to access equities and hedge against an inflationary environment should it persist in the new year.
What are some of those dividend names you like? Because sometimes you might see some flashy yield there, but it comes at the expense of being just a terrible stock to own. So talk to me about both of those things, if there are any names that you have on the top of your list.
Great question. I'll start first with yield. People talk about value traps all the time, and I'm a value guy. So value is something that we're always considering and looking at. And when I think about value, you have to be aware of yield traps. To your point, I mean, AT&T's got a huge dividend yield, but it has over time been a tougher place to compound capital. When we look at companies that have interesting dividend yields and interesting dividend growth rates, one area I would point to is the semiconductor space. If you look at the semiconductor space, you've got ample cash on hand, very clean balance sheets, very healthy dividend growth, whether it's Broadcom, Texas Instruments, or even a Teradyne. So there's multiple areas there. I would also pivot and look at some of the specialty REITs. Some of the towers, in particular, Crown Castle and American Tower, also have very interesting dividend growth rates. So we like those, but we think investors need to be very cautious. To your point on dividends, you can't just say, hey, this is an interesting dividend yield and not pay close attention to the underlying fundamentals.
And lastly, I was looking at your notes, and one thing stood out to me when you look at maybe some home bias in looking at U.S. equities versus the rest of the globe, and you're pointing out a widening gap there. Talk to me about maybe the opportunity that some might be overlooking in emerging markets.
So emerging markets have been down and out. I think some of the worst performing areas would be gold, emerging markets, anything tied to how the dollar is strengthened. So a couple points there. There have only been 3 periods where we've seen the dislocation in emerging market equities to this degree prior to this year. Those periods would be 2008, 2001, and 1998. And so you're getting emerging market equities at valuations we've not seen since the late 90s. And I'll share, kind of an interesting statistic in my opinion. If you bought the emerging market index in October of 98, you were still beating the S&P by 100 basis points a year up until today, which is pretty amazing given that you've had Google, FANG, all these amazing American companies that have done incredible over the last decade. And if you had bought the emerging markets in 98 during the peak of the tech bubble or near the peak of the tech bubble, you're still beating the S&P. So we think that there is value there. And particularly when we look at the underlying fundamentals and the shifting composition within the emerging market equities and that dislocation in valuation, it gets us excited. So we think that there are pockets there. There are risks, of course. So we would, advise investors to approach the emerging markets in a very diversified manner. We don't like big country bets or trying to take those big sector bets in the emerging markets. But if you have a diversified portfolio of companies that are of a high quality nature with stable earnings, growing dividends. We think that emerging markets are an interesting way for investors to hedge some of the gains they've had in the U.S., but also, quite frankly, capture the valuation discount that we have not seen since the 2000s.
Yeah, always interesting, and thank you for putting it in historical context as well. Helpful for investors to understand kind of what's going on there. John Mowrey, NFJ Investment Group CIO. Appreciate you taking the time to chat with us again, man. Be well.